Good afternoon, everyone, and thank you for joining us for this month's installment of Epic Insights. My name is Brian Lenz, Director of Sales here at Epic, and I'll be your host for today's session. Today we'll be discussing the QDIA decision. Fiduciaries today are required to act in the best interest of plan participants, but may not necessarily be familiar with what type of QDIA is suitable given the unique needs of each plan's participants. Participant demographics in every retirement plan are different, and it's vital to understand how this can affect choosing a prudent QDIA. Today, Jim Hakewill and Craig Abbott from Manning & Napier Advisors are joining us to share some insight and expertise along with their interesting tool, QDIA Sync, an online utility that helps remove the uncertainty around choosing QDIAs. Jim is a DCIO specialist for Manning & Napier's intermediary distribution group, where he's responsible for coordinating all aspects of DC advisory relationships with Manning & Napier, specifically in the Eastern region. Prior to joining Manning & Napier in 2010, Jim held positions in institutional equity sales and high net worth client management. Craig Abbott, also on the line with us, is a Vice President and Retirement Plan Consultant, and he works directly with advisors, sponsors, and participants, promoting best practices in plan design and encouraging positive behaviors. Craig joined Manning & Napier in 1998 and has over 20 years of experience in the retirement industry. As always, your line will be muted throughout the call today, but if you do have questions you'd like us to address at the conclusion of the session, feel free to enter those in the questions panel, and we will have Jim and Craig field those at the end of the call. Without further ado, Jim and Craig, take it away.
Thanks, Brian. This is Jim Hakewill. I appreciate the introduction. As Brian mentioned, I'm the DCIO specialist for Manning & Napier, covering the Eastern region, which consists of Maine to South Carolina. As you might imagine, there are obviously pros and cons to having a large territory, but it does provide me exposure to a lot of advisors that specialize in the corporate retirement marketplace. What I'm finding in terms of what they're looking for in the way of value add or intellectual capital is a need for help with QDIA due diligence. To help fiduciaries identify an appropriate QDIA and document that process, we've created QDIA Sync, which is an interactive quiz addressing the impact of demographics on QDIA suitability. As you know, and Brian mentioned, plan sponsors are required to act in the best interest of their participants, but every plan is heterogeneous, meaning that every participant is unique. And in 2013, the DOL put out a tip sheet discussing how to evaluate target date funds. For those that have not seen it, there were 8 total bullet points, but for today's call, I'd just like to point out 2 of them. One was establish a process for comparing and selecting target date funds, and that read, you should consider how well the target date fund's characteristics align with eligible employees' ages and likely retirement dates. It also may be helpful for fiduciaries to discuss with their prospective target date provider the possible significance of other characteristics of the participant population, such as participation in a traditional DB plan, salary levels, turnover rates, contribution rates, and withdrawal patterns. And secondly, document the process. Plan fiduciaries should document the selection and review the process, including how they reach decisions about individual investment options. I wanted to read those 2 specific points because I think the QDIA Sync quiz perfectly aligns with the idea that demographics matter and you need to document your process for QDIA selection. So with that, I'm going to turn the call over to my colleague Craig to provide more background and walk you through the actual quiz.
Thanks, Jim, and thanks, Brian. I would just, before we get into the actual quiz itself, I decided to add a couple comments on top of Jim's, and one is that we've crossed the barrier of about 10 years now since QDIAs were developed and created back in the Pension Protection Act. And really, if you think about the plan design, how it's changed over time from a lot of people trying to make their own investment decisions to now where more and more people are being defaulted into a multi-asset class portfolio that's being managed for them, there's some very good things as a result of that in terms of participant behavior and making sure that they're on track for a secure retirement. But thinking about these as relatively new vehicles, they came out 10 years ago. The first real test for them was in 2008 when we went through the financial crisis, and the impact on near retirees was highlighted in terms of how much risk were involved in some of these portfolios, and some people lost a lot more than they may have thought they could in a vehicle that's designed for folks near retirement. So they got a lot of attention. It's not surprising that just a couple years after that event, the DOL came out with these tips to remind people that these aren't like asset class funds. These multi-asset class vehicles are very different. They're very different designs. There's very different glide paths in the target date industry. So make sure that you're documenting and looking at what you're putting in front of your participants. The common thing that we've seen over time is that the evaluation of the product starts with performance, and obviously having more aggressive products and more conservative products available really depends on the type of market environment that you're in when you're looking at performance. So we don't want to just start there. Obviously important, but demographics are an important place to start to determine what is it that you're trying to accomplish for your participants, and then you can evaluate from there. So on your screen you should see this online link. You can see up here in the browser it's an open web link, so you can go and use this at any point in time. And we've created it to provide a mix between the complexity versus simplicity of data. So it's something you can do pretty quickly. You can answer the questions relatively easily in a few minutes. You may have to go digging to find some of the answers to get them exactly right. But we wanted to make it not so onerous that it took so much data that it wouldn't get used, and also enough data to make it to make the output valuable. So what we've done here is we've got 5 different demographic assessments that Jim's already touched on briefly, and you can go through and answer these questions relatively easily, starting with risk considerations. And here we're looking at really what's the sponsor's view of the overall participant base. Do they believe that the individual age is more important when making a default decision, or the overall plan demographics? So you can see there's a spectrum here, and you can very easily select where you are on the spectrum. So as we go through, I'm just going to answer some of these questions and move on and get to the end where we're going to see the output report, which we'll touch on briefly. But you can, again, use this as you like. Second question here in terms of risk considerations is, how would you reflect the overall risk-reward profile of your defaulted participants? So as you think about your plan or a plan that you may work with, you can think that, maybe I got a more growth-oriented group. Maybe I've got a group that's much more concerned about capital preservation, or somewhere in the middle. So again, more of a sponsor view of the overall population that you're working with. The next group of questions are really around savings adequacy. So we're looking again at defaulted participants. So the very first question is, what is the initial default contribution rate that people are automatically enrolled at? So you can see, you can move this slider. A common default starting point is 3%, but we can go up and move it to 4, 5, even 6+. These questions together, we're looking at the overall savings rates of your defaulted participants. The more you tend to save, the more assets you will be able to accumulate, and ultimately the more assets you have, the more capacity you may have to take on risk as you get to retirement. A downturn in the market may not be catastrophic to you at that point if you've saved enough or more than you may need. The flip side is, if you have not saved enough over time, and this is your sole retirement savings, when you get there, a large drawdown may be very, very impactful to you. So we're trying to get an idea of what is the overall savings rate of your defaulted participants. A lot of plans will have automatic escalation in terms of not just the automatic enrollment rate, but maybe you're automatically increasing people over time. So we can take that into account in the next question. And then finally, the last source of employer contributions in terms of the employee's access to new assets. So you can say, if there's an employer profit sharing or an employer matching formula, I can put that up at whatever level that may be. So again, this group of questions are looking at the savings adequacy of your defaulted participants. The next section we're starting to look at other potential sources of retirement income. Why are we asking about this? The first one is, do you have access to a defined benefit plan? A lot of glide paths in the industry are created based on very general assumptions around participant savings rates, Social Security benefits, longevity, and so forth. They do not typically take into account having a pension. A lot of people do not have pensions today. So one of the things I should have mentioned on the outset is this questionnaire, this quiz, will lead to a QDIA type, and there's more than just one QDIA type. Obviously, target date funds have been one of the most popular QDIA options in the industry and growing in use, but you can also use a risk-based or a balanced type portfolio as a QDIA. And in addition to using a target date fund that might be provided by a fund company, you can also create custom target date solutions. So this questionnaire actually contemplates all three of those options as potential QDIAs. And for example, if you had a pension, if your plan has a pension, and that's kind of a backstop for retirement, that may impact the type of glide path or the type of default you may use for the folks in your 401k plan. So that may lead you down more of a custom path if you do have that type of benefit available. The next question, what is the likelihood that you've accumulated significant assets outside of the plan? Obviously, we're talking about creating an investment allocation for defaulted participants of the assets in the plan. If there are substantial assets outside of the plan, or a good chance of that, the impact of the glide path in the plan may have little or no effect depending on how many assets are available outside the plan. So really what we're thinking about here are more mature hires. Maybe you're bringing in people who have worked at other companies, older individuals, so the assets inside of this plan may be a smaller portion of their overall retirement savings. The next section is talking about participant behavior, particularly when you're looking at when they leave employment. So the first question is, what typically happens in terms of the turnover in your plan? Do you have a high turnover workforce or a low turnover workforce? In terms of why would that matter? If people are turning over quite frequently, they may not be staying in your plan and going through a glide path over time. They may have a shorter time horizon, so that may impact the type of default that you would use. What happens when they terminate employment? Are they leaving the assets in the plan, or are they rolling them out upon termination? Again, we're looking at the time horizon that these assets may be invested within the plan. And ultimately, what happens to people when they do hit retirement? What are they doing in terms of distributions? Do you see most people rolling the money out immediately upon retirement? Do you see that people take withdrawals over their life expectancy, or somewhere in between? Again, we're looking at a very important consideration, especially when you're looking at glide paths, is what happens to the assets when you get to that all-important target retirement date. And then the final set of questions is really based around the age demographic of your particular plan. The first one, what age do you expect participants to retire? Very standard 65, but you could see that a really unique plan might have a much lower or much older planned retirement age. That would be important, again, if you're thinking about where do the typical glide paths in the industry, the types of assumptions that product manufacturers have made to create their glide paths. Most of them are built around pretty standard assumptions about retirement, what age that will be, how long you'll live in retirement, how long you need these assets to last. If you had a much older retirement age, for example, you've got longer to accumulate savings, you've got a shorter period of time in retirement that you may need them, so you may warrant a more customized solution to your glide path as an example. But we'll leave that there at 65. The next looks at the distribution of ages in terms of your population. Do you have a clustered group of participants all around the same demographic, or more of a diverse workforce across different age ranges? That could be important, again, if you're looking at more of a balanced QDIA instead of a target date type solution where all assets would be managed according to one investment objective for everybody as a whole, that would more align with a more clustered workforce as an example. And ultimately, what's the average age of your overall participant base? Do you have a younger population, older, or somewhere in the middle? So I think after looking at these 13 questions, you can see how you can navigate through them pretty quickly. And as you get to the end, you'll notice here we've got a recommendation based on the overall demographic and the answers in this that we've added here, that a target date portfolio with a conservative glide path design might be an appropriate approach for your plan. In here, you can put in your name, you can put in an email address and your plan name, and you can create a report. When you create that report, a PDF will pop up, and instead of doing that now, for time reasons, I'll pull up a sample report. It looks something like this. So you'll get a output report customized to your plan with your answers, and it's very short, it's pretty straightforward. The very first page is going to be a summary of your answers. So all we're looking at here with these green boxes are the answers that we've put in as we went through the quiz. So again, a summary of the demographics of your particular plan. The next page is going to be your QDIA Sync results page. So the very top, you're going to see the QDIA solution. In this case, was a target date fund. That could have been a balanced or a risk-based type fund if the answers were different. The QDIA type, in this case, it says traditional. Traditional meaning an off-the-shelf target date fund from a product manufacturer, from a fund manager, likely will meet the needs of your plan. Your demographic was not so different that a custom solution might be warranted. This could say custom as an example. Next, we're going to see the risk profile, and you can see that it's broken down into 3 different categories, from conservative, moderate, to moderately aggressive in terms of the type of profile of your overall participant base. And what you'll see is this case, we've got a conservative kind of risk-reward profile. You'll see some of the confirming traits listed. But in addition to that, we've got other traits that may not align with that conservative approach listed over here. High contribution rates, high presence of outside assets. Gives you a little bit of wiggle room to say, this doesn't say you have to necessarily have a conservative glide path, but you have other considerations to take into account if you wanted to go outside of the kind of the output of this report. Oftentimes we see people doing this. A lot of the traits line up. It's fairly common to see that a lot of the traits are kind of pointing to one approach over the other. And then ultimately on the bottom of the page, you'll see the investment characteristics for a conservative glide path. And all we've done here is gone beyond a little bit to versus through. To managers, meaning you hit your landing point at the target date. Through, meaning that you're managing and you're going to hit your landing point past the target date. And try to give a little more robustness to what is a conservative glide path. The landing point, 0 to 5 years. The equity allocation, we're going to focus on the 10 years before and after the target date in terms of what is the equity allocation. And as you'll see here, it's not recommending one glide path. It's really giving you guardrails around what type of glide path, what type of allocations would support a more conservative glide path design. So it's not a product recommendation. Nowhere in this report will you see a product or a specific manager. It's really intended to look at the demographics of your plan and determine a type of approach and a type of risk profile that might be appropriate. And then from there, you can move on to finding QDIA solutions in the industry that fall into some of these guidelines. So for example, if you have a current manager, you have a current glide path construction, you could take this and see if it supports the type of decision that you've made. So it can work with any type of solution that you may be using, but again, it gives you the chance to go back and remember what type of approach did we select, and then we can go ahead and evaluate performance and other metrics in light of that decision. The last thing I'll say before I stop kind of the presentation at this point is in the back of this report you will see the different questions why we ask and why we ask them, so that you can go through and say, well, why would you ask a question about your plan's defaulted participants risk-reward spectrum, and you can read why. So it really arms you to understand a little bit more about the workings of the particular tool. So with that, I will kind of open it up, I think, Brian, to questions. And also, while I'm doing that, I will go back to this report that is also attached. And this is something that Jim started talking about with the DOL tips. And this report is a separate report that does look at different glide paths in the industry. It's a customizable report that we can look at and identify different target date managers. You can see different glide path constructions. And again, we can narrow this down and bucket it by more aggressive approaches, more conservative, more moderate, depending on the type of output that you may get from the QDIA Sync. So this is an additional tool, not going to spend time on today, but it's a kind of the next step after going through more of a suitability assessment for your plan.
Great stuff. Well, thank you very much, Craig and Jim. Looks like a very simple and straightforward way to analyze and make sure that you are really following a documented and prudent process for selecting that QDIA, which, as we all know, more and more assets are trending towards, with automatic enrollment and participants really wanting a do-it-for-me type of solution. So, to mitigate liability, this is a fantastic way to document that process, and probably something that every few years you should be running each of your plans through as an advisor. I've also found, just personally, in looking at the Why We Ask section, that's a great resource for advisors as well, to position yourselves as an expert with plan sponsors, familiarizing yourself with really what you should be looking at for decision points and why that matters. So great stuff there. A couple of questions have rolled in. It seemed like actually you might have addressed this in the last minute there, but have you found it easy to match the output with an investment solution? Let's say on the smaller plan size, where totally custom solutions or custom collective funds probably aren't going to be an option. Have you had success with matching up the output of the QDIA Sync with a readily available investment solution, and do you have any good resources to do that?
Absolutely, and this is Craig. I'll start with it. Really, what we've seen is the vast majority of the folks who complete the questionnaire end up with a traditional or off-the-shelf type output. Very rarely do we see custom come into play, and that makes sense, as you really wouldn't expect to have to design a custom solution because the demographics of your plan are so different. So the first thing is, custom is rare in terms of the output. In terms of being able to find off-the-shelf solutions that line up with the output of the report, we found that to be quite flexible as well. A lot of providers will have different types of solutions available. They'll offer different managers, and there's managers that are more aggressive, and there's also managers that are more conservative. So they're really all across the board, and most record keepers are offering some flexibility in terms of what managers are available. The other thing that I would add, though, is this doesn't say it has to be a traditional off-the-shelf fund. It says a traditional approach can be perfectly appropriate based on your demographic, and that can even support if you're using a kind of a rebalancing type or a glide path tool, creating funds, creating a more of a glide path out of the record keeping rebalancing tool, or some sort of online resource available through the record keeper. So it doesn't have to, traditional doesn't have to mean an off-the-shelf fund. It can mean some sort of a tool that takes more of a standard approach to the glide path.
Okay. Yeah, good to know. Is obviously worst case scenario, you go through this and get a recommendation, don't follow it, and outcomes aren't good, I mean, that's probably opening yourself up to the most liability because you've seen you should have been maybe doing something different, you don't do it. So actually implementing and finding a tool to implement that is important. And of course, through Epic and our custodial partners, we are open architecture and probably have a solution that meets your needs. Related to that, Craig, in a, I guess, small a nutshell as you could put it, are there some keys that you have seen that would lead the output to a risk-based versus target date fund versus just a balanced solution? Are there, to oversimplify it, a couple of key points that would drive this one way or another that you've seen in practice?
Yeah, there are a couple. It's a great point. It's if you have a plan sponsor that's looking more at the overall demographics of their plan, going back to that very first question, thinking that the overall plan demographic is more important to my default decision than maybe individual ages, that's going to move you more down the path away from maybe a target date fund towards a balanced fund. The other questions that'll kind of support that are really around the demographic of your participant base. So if you have a very clustered group of participants centered around a common age, common demographic, balanced fund may take into account and meet the needs of the vast majority of those. So more of a clustered dispersion of ages, and as opposed to a more widely dispersed group of participants would lead you a little bit more towards a balanced approach as well. So that's a couple. There's also a high degree of turnover. If you've got a high degree of turnover and people really aren't staying and going on a glide path towards retirement and into retirement, but they're only there for a short while, the time horizon of that group is shorter, the glide path is less important, so more of a balanced approach could be appropriate.
All right. Well, great stuff, Greg. Thank you both for joining us today and sharing QDIA Sync and your insights. We really appreciate it. And thanks to everyone for dialing in. We hope you found it valuable and informative, and hope to see you at another installment of Epic Insights. Have a great afternoon.
Great. Thank you, everybody. Goodbye.
Thanks, Brian.